from running a node on your computer, a solo staker, to like being an institutional grade operator, there's a couple of things that differ. We tend to overperform the network a little bit. We do MEV, introduce timing games. You delay a little bit, block proposal so that you can get a little bit more MEV. And then like we are the largest independent node operator.
Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Friederike Ernst, and today I'm speaking with Laszlo Szabo, who is the co-founder of Kiln, an institutional-grade rewards platform which offers staking and DeFi access. Before I talk with Laszlo, I'd like to tell you about our sponsors this week. If you're looking to stake your crypto with confidence, look no further than Chorus One. More than 150,000 delegators, including institutions like BitGo, Pantera Capital, and Ledger, trust Chorus One with their assets. They support over 50 blockchains and are leaders in governance on networks like Cosmos, ensuring your stake is responsibly managed. Thanks to their advanced MEV research, you can also enjoy the highest staking rewards. You can stake directly from your preferred wallet, set up a white label node, restake your assets on EigenLayer or Symbiotic, or use their SDK for multi-chain staking in your app. Learn more at chorus.one and start staking today.
This episode is proudly brought to you by Gnosis, a collective dedicated to advancing a decentralized future. Gnosis leads innovation with Circles, Gnosis Pay, and Metri, reshaping open banking and money. With Hashi and Gnosis VPN, they're building a more resilient, privacy-focused internet. If you're looking for an L1 to launch your project, Gnosis Chain offers the same development environment as Ethereum with lower transaction fees. It's supported by over 200,000 validators, making Gnosis Chain a reliable and credibly neutral foundation for your applications. Gnosis DAO drives Gnosis governance, where every voice matters. Join the Gnosis community in the Gnosis DAO forum today. Deploy on the EVM-compatible Gnosis Chain or secure the network with just one GNO and affordable hardware. Start your decentralization journey today at gnosis.io.
Laszlo, it's a pleasure to have you on.
Thanks, Friederike, for having me.
So you've been in this space for quite some time, but maybe let's focus on what happened before. So tell us about your journey leading up to founding Kiln.
So I did an hospitality school, so nothing related to tech or even crypto. Then I discovered Bitcoin in 2014. I found this guy very interesting in Japan actually that was building BRD wallet. I don't know if you remember. It was one of the largest Bitcoin wallets at the time, and he explained me Bitcoin and digital gold, the whole story behind it. So I bought my first Bitcoin back in Europe, and then in 2016 I had a childhood friend that started to work at Consensus. So Consensus in 2016 was working on Variable, which is basically trying to do a decentralized stablecoin, like a type of maker at Consensus. And yeah, I was just mind blown by this idea of like world computer Ethereum, decentralized applications. So I invested it in Ethereum in some Ether in 2016, but I never really came for the financial aspect of it. I've always, and I think still very bad at like managing my own money. Maybe I shouldn't say this on the podcast, but so no, I came for the kind of the tech, and then like 2017 was the crazy ICO period, and then I was just FOMO'd. I was already an entrepreneur since 2015 because I launched my tech recruitment company 10 years ago. So also when I started to look at blockchains and crypto in general. And in 2017, I was just two things. First, frustrated to not work with the engineers. I was recruiting for other companies. I wanted to build products with them and not recruit them for other companies building cool products. I wanted to be, on the other side of the river. And then also I was just FOMO by the blockchain and crypto ecosystem as a whole. I think I did a first meetup in 2017 in Paris. And when you do a meetup, like you just find a bunch of nerds, builders all together. And I was like, okay, a week after I was like, I'm done with recruitment. I'm still shareholder of this company in the south of France. They're still good friend partners. But I'm like, guys, I need to try to build a company in blockchains, and that's what I did.
There's a lot to unpack here. So how kind of coming from a hospitality background, how did you get a leg up in kind of tech recruiting?
Yeah, there was. I think just my friends in Marseille, south of France at the time, just went to be and said, "Hey, we want to build a company. We don't know what to build. We just want to be entrepreneurs, and because we don't think we any other companies will like to hire us. We are not recruitable."
This is a great start for a tech recruitment company, kind of like trying to kind of help unrecruitable people.
That's right, exactly right. So, you're the best consultants, because at least you can tell not to candidates not to look like us at the time, so that they get more chance to get hired. But yes, and it came to me, and I was still finishing my hospitality school. Say, hey, you are from Paris, and tech is very centralized in France, and you might know more companies that want to recruit engineers. So do you want to be part of the journey while we find the engineers? You have this relationship with these startups that want to recruit. And I'm like, yeah, well, guys, okay, but I need to finish my school and everything. So if it doesn't work after months because I don't have time or I'm not just delivering, we'll shake hands and you will move on. So that's we started, and it kind of worked. And then I got just very, very excited about the tech industry in general, right? Like and very excited about engineers. For me, was
We're good
kind
people.
of the good people, the artists of like the 21st century. It's like I think that it was the best part of my job. Is like sometimes it was a hard job. Recruiting is a hard job. You have to scrap numbers on LinkedIn and then call like 100 people. There's 70 people that won't be interested or even not answering you. 27 people that are answering you but say they're not interested. 2 people that literally insults you. It's like, oh, where did you find my number? And maybe one person saying like, oh yeah, maybe this job might be interesting for me. So it's a hard one, but sometimes you have a discussion with 30 minutes, an hour with an engineer talking about like AI or at the time, blockchain. And you just like find this person so passionate. It's like, wow, if I get to work with this person every day, my life would be better.
That's a super nice blockchain origin story. Let's talk about how you honed in on kind of the staking space, because kind of Kiln kind of started off in Ethereum staking. So how did you identify this as a target for your own company?
Yep. So 2017, 18, from a recruitment background, the only thing I knew was like, I was trying to put CVs on chain, a wallet for candidates that would certify the fact that he worked for this company on this mission and was the next employee. He would show certification there. Maybe with zero knowledge, you would, kind of like a decentralized professional ID. Then we obviously pivoted. We tried to explain this to the French state in 2018. They were like, what the fuck are you talking about? So then we pivoted, and in 2019, we did our first blockchain as a service platform. At the time in France, Consensus actually had a office in France, and most of the proof of concept being done were on private blockchain. So I kind of like, we're deploying like private Ethereum, Quorum, Corda, these kind of stuffs, where it's like today sounds terrible, and I think they were. But I was looking at the staking space from 2018. I had friends at Cosmos like Gauthier Marin and others that were launching, or even like the OGs like Chorus One, Stickfish, P2P. They were launching validators or participating in the Cosmos network. For me, it was just too much of a retail market. I didn't understand it, right? Like I couldn't grasp the understanding of it. And seeing at the time, Bison Shells, Joe Lelou's, explaining that the platforms, exchanges at the time in 2019 and 2020 will be able to offer staking to their users while retaining, making it as a business model. I was like, okay, now I understand it. Like a B2B type of company that you'd leverage to then have like indirect hundreds of thousands or millions of users. So in 2020, the first staking product we launched was for Pocket Network. It was a decentralized RPC network. We were offering RPC ourselves. So like, wow, if you can decentralize it, this is genius. So like Michael, the CEO, I met him in Berlin, actually, in Berlin Blockchain Week 2019. I was like, wow, this guy is so smart, so bright. And if the future is decentralized, the access of blockchains are decentralized, that could be, we could potentially be part of it. And in 2020, he comes to HGC in Paris. We do an event and together in the office, and then he covered it, and he comes to me and say, "Hey, man, like I need a professional infrastructure company to offer staking to my investors while deploying nodes, and it's a pure proof of stake network. So it's not a delegated proof of stake network, meaning that every X number of tokens, in that case was like 15,000 number of tokens, you have to launch another validator. So we're not running one validator on Pocket. We're running like thousands of validators actually, right? It was fork of Tentaments at the time. And anyway, we built this. We was like, okay, we didn't find a market on RPC, so let's focus on staking. In summer 2020, we ready to launch the product. We launched the product, and it's DeFi summer, so price goes up. The demand for staking is just like insane, and suddenly we, from 0 customers and struggling in blockchain for 2 years and a half, like we had like 50 customers in 2 months, right? From everywhere in the world, like US, New Zealand, Europe. So yeah, our product was terrible, but we found a market. That was the first staking product we launched, and then Ethereum was a very natural evolution for us, because Ethereum was the first major pure proof of stake network, right? You would have to run a validator every X number of token, as on Pocket. Every 32 ETH, you have to run a validator. So we were good at like running validators at scale on really on Pockets. It's just there was a much bigger protocol to secure, a much bigger playground. So we launched our Ethereum operations when the Beacon chain launched in December 2020, and quickly we also had Lido as a customer. So I have to shout out to the Lido team for trusting us at the time, because we're not known at all, and we owe them quite a lot. And then guess can give you more details about the rest, and rest is history. But that's how we started.
Give us some nuance for what it takes to kind of run a validator, kind of at an institutional grade for clients, because kind of I think a lot of people will have experience with kind of like running kind of like an Ethereum or Gnosis chain or so validator, but usually it's pretty there are some challenges, and these are kind of the networks on which it is super easy to kind of run nodes, right? Kind of like there's a lot of networks where kind of running a node is extremely, it requires very close maintenance and the professional expertise. So kind of give us some nuance to kind of like what it takes to kind of operate this as a business.
No, that's a very good question. Yeah, first off, you're right. There's some blockchains, for example, Ethereum or Cosmos, where it's easier to run validators than like on Ton, for example. For those who know Ton, we love Ton. It's a fantastic blockchain. It's just harder to operate in. And yeah, I mean, even on, let's say, Ethereum, from running a node on your computer, a solo staker that you mentioned, to like being an institutional grade operator, there's a couple of things that differ. First, we tend to sometimes sometimes, but on regular basis, overperform the network a little bit. I guess that's the first type of advantage that we offer our clients. Meaning we do MEV. We introduced we're some of the ones that introduced timing games in I think September 2022, if I recall, because there was papers from the foundation, but nobody really put it in production, so that you delay a little bit the block proposal so that you can get a little bit more MEV. And then we did a lot of research, was how the network will be impacted by this, and with definitely all the node operators and the foundation themselves, so that we work hand in hand, not to slow down or not to impact Ethereum as a whole. And we found kind of a recipe. So this is the first advantage. The second is definitely the rewards, right? The rewards part. And in on-chain rewards, on-chain yields, there's always this risk and rewards components. So rewards, we try to overperform the network a little bit. This is the case on Ethereum. This is also the case on Solana and other networks. The risk part is also very, very, very important when you try to be institutional, right? So you try to offer first insurance in case of slashing. This, I think $3 to $4 million is the total amount that has ever been slashed on the Beacon chain, which is quite minimal if you look at the number of billions assets that are staked. But still, we try to be insured in case there's a slashing event for clients, so that they are sure their clients will be paid back. Then we try to have internal security measures. We try to avoid double voting, double proposing, and we double signing. And we have and we published some blog posts with the foundation on this, actually. Even our validated monitoring tool is open source. If you're a solo staker, you can use it. But you never want to be slashed, right? And slashing measures are like a Swiss cheese. It's a couple of layers. It's double slashing, double voting prevention. It's definitely insurance. It's definitely monitoring at different level, external and internal monitoring. It's the signing. We use Web3 signer, but we might use more type of HSM signers when we sign blocks in the future, and you decouple the signing from the validator infrastructure, and then you spread this validator infrastructure across the globe. And lastly, we use different validator clients, Prism, Lighthouse, and Teku. We were 1/3, 1/3, 1/3, so we'd split. But we realized that if you run a majority client, so for example, Lighthouse and Teku, Lighthouse and Prism, that have more than 33% of the network, you might, in case of a large slashing event, a bug on the client, it might be very damaging for all infrastructure. So we decided to actually reduce drastically the Lighthouse and Prism exposure that we have and run a majority of Teku validated clients. Anyway, I hope I don't go too much into the weeds, but all of that is how you differentiate from being a solo staker.
Maybe we can just very quickly kind of give some color to some background to the slashing discussion. So kind of the background here is that kind of if you double sign, you're always slashed. But kind of if your validator just goes down and stops kind of attesting and proposing blocks, then you're slashed based on how much of the network kind of goes down with you. So kind of if you're just a solo staker and kind of you lose power on your server or something, that actually doesn't get you slashed a lot. But kind of if you and half of the network go down, that is actually a very slashable event. So kind of you want to prevent kind of your users to be penalized that way by kind of being caught in a situation where they are a large part of the network, or they are part of the large part of the network that kind of goes down, right?
Yeah, that's right. But so you said it being down will be always less damageable. A larger part of the network goes down at the same time than being slashed. So we have a mantra internally is like better be down than slashed, right? And there's a couple of events that you it's okay to be down, or you're fine to be down, right? Then like avoiding a slashing event.
Tell us about the team that it takes to kind of operate this. So I just know this kind of from our side. We operate a number of nodes and kind of like archival nodes and so on. And I know that our DevOps team, they do a lot of monitoring, and they have kind of like they have on-call duties and so on. So how is that set up within Kiln, and how many people do you have dedicated for kind of just maintenance of infrastructure?
Right. So we have a team, and infrastructure for us is two sides, is like running the nodes, but it's also staking data, which is also like setting you apart from like being institutional staker. Like, for example, and I'm happy to come back to it, but if you're an ETP or an ETF and you offer a staked ETP, then you need the granularity of the data to get staking reconciliation. What's the NAV? What's the rewards on daily, weekly, yearly basis? The data needs to be, and that's actually a very, very tricky part. Indexing. I mean, you know this, right? But in blockchains, you have two types of data. You have like the execution layer data, smart contracts, and the consensus layer data. And consensus layer data, we very few on the planet to just like index it, because it's usually means you need staking data, right? So it's usually like institutional staking providers that does it. So we have a team of 15 DevOps just running all the infrastructure, running the nodes on 47 different chains. And as you mentioned, there's on-calls. So 24/7, they have an application on their mobile, and they can be waken up at 4 a.m. On Saturday morning, and that rotates. And today it's mainly concentrated in Europe, but in the future we could have teams across the globe, so that maybe like you don't get waken up at 4 a.m. on a Saturday morning. So and then on the data part, it's another 15 other people. They're working and indexing 20 different chains. So and it's validator agnostic, right? So we don't only index our validators. A lot of our clients actually are using our data to index other providers, because they're using 1, 2, 3, or 4 providers because they want to spread the risk, because they want to have more coin coverage and so forth. But they're still using our data to index the network, and then get the NAV, get the rewards on all these validators and so forth. This being said, coming back, that's the recruiters talking. It's not about like number of engineers at the end, right? It's never about the number of engineers. It's always about like spending a lot of time to finding the right engineer. So you might say, 15 and 15, 30 people. Oh, it's a big team. Well, I mean, but the number of things they're doing, it's quite a small team, I can tell you, right? And I meet every one of them. I know all of their names. Some of them I've been working for 5 years. And some the ones, for example, in charge of Ethereum and our Ethereum infrastructure is called MXS, or Sébastien Ranou. He's doing a lot of research himself. He's doing open source with our Ethereum validator, Watcher being like our monitoring tool to monitor Ethereum validators. He's doing open source with Commit Boost, so basically the pre-conf project post Pectra that we'll use. Working a lot with the foundation, doing some research about the impact on MEV, for example, on the network and so forth, so on and so forth. So they're not only DevOps, right? They are protocol specialists in a way.
Yeah, absolutely. Can you give us an idea how much of the staked ETH is staked via Kiln, and kind of compare this to other networks you're also operating on?
Yes. So in total, we have 13 billion assets that are staked on the platform. So we have 4.6% of the Ethereum network, which means I don't want to wrong the numbers. I think it would mean like between 5 or 6 billion of assets or so dollars of ETH that are staked through validators running 49,000 validators. And yeah, that's I think kind of about it. We say that we are the largest independent like node operator, meaning you still have like large platforms like Coinbase. You can argue maybe Binance, they're running more than we do, but like as an independent staking provider, yeah, we tend to say on Ethereum we're the largest.
What are your biggest clients?
Yeah, so we work with exchanges, wallets, custodians, asset managers, so the ETF, ETP like, and neobanks, and maybe the banks and the like that are coming into the space. And we have a couple of direct clients. It's a small portion of the business, but when you go on Ledger, for example, or you go on Safe, Safe has a marketplace, and you can stake directly through dApp. So you will see Kiln there. Most that I would say that's 5 to 10% of our volume. 90% of our volume, it's actually our white label infrastructure that is used by, I don't know, Bitpanda, that is used by Coinbase wallets, that is used by Fireblocks and alike, so that their customers, either retail or institutional customers, can stake.
We should probably stress that kind of like all the staking that you guys do is non-custodial. So I mean, kind of like if you kind of have funds on an exchange, on a centralized exchange, and kind of you let them stake for you, kind of they are in custody of your funds, but you are never in custody of someone's funds. So kind of how does this work on a technical level?
Yep. So the exchanges and in exchange, for example, we use our APIs that then like points to a validators, and our APIs automates the flow, the staking and unstaking flow, and also give them the right data. Right? Hey, today, you have staked this number of amounts, and you have earned this number of rewards for this number of customers. A wallet will use, for example, Safe will use our smart contracts, and we have a smart contract platform so that on Ethereum, for example, you can stake 32 ETH, a validator. If you want to stake validator, that's how you are. For example, CoSwap is on also it's the white label solution that is used for the swapping engine on the Safe interface. We are now the white label solution for the staking engine on the Safe dashboard. For now, you can only stake 32 ETH, so a validator. But maybe in the future, you will be able to stake any amounts of ETH if you don't have 32 ETH to stake. And in that case, we have a smart contract that pulls customers' funds and then redirect to a validator. That's validator agnostic. For example, some of this smart contract on-chain rewards management platform is used by Coinbase Cloud, for example. And they're running the nodes, but they for Coinbase wallets, but they use our smart contract platform to offer pooling staking so that the customers non-custodial can stake any amount. Or Consensus is offering 32 ETH staking while using our smart contract on MetaMask. Yeah, that's the type of non-custodial staking that we can also offer to our customers. Custodial staking with the exchanges, the asset managers, and some of the custodian that are regulated custodian, or non-custodial staking for wallets or technology custody.
That's super interesting. Kind of, I want to come back to that in just a second, but maybe kind of let's zoom out a little bit. So kind of when we look at kind of the evolution of staking on Ethereum, or maybe even preceding the switch to proof of stake on Ethereum, what do you see as kind of the major milestones kind of in the history of proof of stake in this ecosystem?
Yeah, that's a good question. I think, I mean, the first, I remember doing a presentation like the history of staking, right? Like the first staking protocol were like 2013, 2014 were kind of the first iteration of staking. Then like in 2014, 2014, Ethereum already speaks about proof of stake in the white paper, and they say it's going to be next year, right? Next year for the next 5 years. And then in 2017, 18, you start to have, I would say, the first proof of stake network that launched at scale. So it's Cosmos, it's Tezos. In 2020, and basically in 2017 to 2018 is like, hey, we're just going to do like a smart contract platform with staking. It's not going to be scalable. At the time, the scalability was not yet, I would say, part of the discussion, or even like, technically available. Or in 2020, you start to have smart contract platform using staking that say, we're going to be a proof of stake network, and we're going to be scalable on L1. So that's Solana. And then in the end of 2020, Ethereum's 5 or 6 years after saying that staking will be the end game, finally launched the Beacon chain. And 2 years after launching the Beacon chain, they move finally from proof of work to proof of stake. That's kind of the history of proof of stake network. The history of adoption of staking, I would say, would be that we feel that until 2019, 2020, it was, and even ahead, because Lido also was a wealth to retail type of adoption. I would say since 2019, 2020, then the adoption became very platform, right? So you would start staking from an exchange, you would start staking from a wallet, you would start staking from a custodian, versus you invested in the ICO of Solana, and you would delegate directly to a validator, right? Like none of the Ledger, Fireblocks, Safe, or Bitpanda, Coinbase, or Bybit at the time would tell you, hey, by the way, you have, Solana on my platform, so you can start to stake. This came a little bit after. And so it was very platform adoption, I would say, from 2022 onward. And now you really seeing, because everybody's saying, oh, in the institutional adoption, what institutions means, right? But you're really seeing like traditional financial institutions that are and will start to stake. And it starts with the ETPs, ETF, right? So for example, in Europe, we have VanEck as a client. VanEck is a traditional financial institution in the US that has ETPs product in Europe, and can start to say you have a ETH staked ETP, so that you invest in Ethereum, but you also invest in Ethereum that get rewards annually with staking. And it's not yet available in the US, but you might argue that maybe this year or the next year, now that the administration is changing and is becoming pro-crypto, staking is going to come for these products. So, and then from now on, other institutional type of players will start to offer staking. The banks, the new banks, the banks, the other large pension funds and hedge funds, and we have very meaningful discussions with these players who were looking at us like crazy degens 3-4 years ago.
Yeah, I totally hear that. One of the things that kind of no one, I think, initially kind of foresaw was the emergence of both kind of liquid staking and then restaking. So kind of with liquid staking, the idea is that kind of you stake, and for instance via Lido, and you kind of get a representation of your stake token back, so you can use that as collateral and you can kind of leverage up. How do you view that? Because kind of you don't offer that to your institutional customers, right? So there's some opportunity cost for them there.
So we do offer liquid staking to our customers, and there's two offerings we have. It's one, if you're a retail platform, an exchange, or wallet, you can offer liquid staking. We do liquid staking as a service with pooling, right? So let's say you're an exchange, you want to launch your own ETH, the name of the exchange or the name of the wallet ETH. And in that case, it's very similar to white label Lido if you want.
Okay.
And we do offer liquid staking for institutions, ETF, and alike. We tokenize the validator, right? Because we think an ETF needs liquid staking because they can stake us more than a specific amount of the ETF of the fund, because they still need to be liquid on a daily basis. They have T+1 or T+2 redemption requirements. And the way for them to stake more would be to use liquid staking solutions, but they don't want to use pooling solutions, commingling solutions, because it would mix jurisdiction, right? Like when you stake on Lido, for example, you have people from all over the world staking in the Lido pool, and we think it doesn't fit them. So what we did is we tokenized the validator and we represent it with an NFT, and this NFT can be traded from one ETF to the other, or from one ETF to a market maker. Anyway, coming back to liquid staking, I think it's a fantastic product, and Lido really explained to the crypto market with the adoption of the product that it's a needed product, and the first staking is the primary rewards, the risk-free rate, if you will, of crypto, but it's not DeFi, right? It's a protocol reward, where liquid staking became the first DeFi product and start to flow this reward back to lending borrowing protocols, or liquidity providing, or options and risk-free rate protocols, and so forth. So liquid staking is very needed. First of all, because you need liquidity, but you might need higher source of rewards, and you can't combine this staking rewards with other type of rewards if you don't have a liquid staking token. So I think liquid staking is great. Of course, it introduces a bit more risk, right? What are these risks? So of course, the smart contract, like, staking is the risk of staking is quite low. I told you it's $3 to $4 million slashed on dozens of billions of dollars of assets are staked. On liquid staking, you start to have a complex smart contract, and we build a smart contract ourselves. So I can tell you there's a risk there. It's not risk free. Then of course you can mitigate it using great auditors and using continuous smart contract monitoring tools. And of course the security standards from like 3 years ago to now completely changed. I think the industry is much more mature in that regard. And then restaking. I can talk about restaking as well. But I see maybe just this. I see staking as the use of the staking position horizontally. And I see restaking as the use of the staking position vertically, right? Like you think the other way around. Anyway, but basically, restaking invented by Eigenlayer was explained to the market, as Lido explained, to the market, that liquid staking was a thing and was the primary DeFi source, primary DeFi protocol, that restaking could be used to secure other networks or other applications that need decentralization. It's quite complex, and I'm sure you've launched, Federica, your chain, so it's complex to launch a chain and to manage a network, right? You have to manage go-to-markets, or you have to manage a lot of validators, and do these two things at the same time is actually very, very time consuming. It's often not at all the same thing. And what's your chain and your token is going to worse if you don't focus on go-to-market. So Eigenlayer come and say, hey, if you are a startup, if you're a project, and you want to use this decentralization, this validation marketplace, we already have a set of validators that you can use, and you can use our platform or marketplace to bootstrap your decentralized application and project. Yeah, that's very compelling. Let's see, how it and where it ends with the maturity of all these AVSs and startup that was launched with Eigenlayer, and now Symbiotic is the kind of the second mover on Ethereum, and Babylon on Bitcoin. But that's interesting from a startup project decentralization application point of view. That's also interesting from the other side of the marketplace. It's like, hey, I have ETH, I have Bitcoin, and suddenly you introducing this new type of rewards on the market. This is not staking plus DeFi. It's staking plus staking. It's two type. I get rewarded two times or three times to secure 1, 2, or 3 network with the same security pool coming from Ethereum or Bitcoin. That's a very interesting concept, and that's something that our clients, even if they are taking the time to use or integrate these products, they're looking at on regular basis, and I'm confident this ecosystem will grow.
Do you think it potentially messes up the security of the underlying protocol, in this case, Ethereum?
Yes, it could, for sure. Leveraging the security of Ethereum with 5 or 10 different networks with the same security pool, that could mess up Ethereum. That's a very good point, and I think it's hard to tell where the guardrails should be. Is it at the protocol level, but then it's not really permissionless? Is it at the the DAO level, the community level? Maybe a combination of all of that, but leveraging on Ethereum should be prevented somehow, because you're not you are playing with the security of the network. So that's the risk for sure. But does like an Oracle protocol or a stablecoin or anyone building around Ethereum or even Bitcoin now won't want to leverage the security of the underlying protocol? I think they should, right? I think it's a interesting mechanism that they should leverage.
Mm. How do you see the staking ecosystem kind of evolve over the next? Let's talk about long time scales in terms of blockchain. Let's say over the next 5 to 10 years. How do you think it's going to evolve? Is it going to be all kind of institutional grade staking providers, or do you think we'll still have some solo stakers, or do you think the pendulum will actually swing the other way and kind of we will have a majority of smaller smaller solo stakers or staking providers?
Yeah, that's that's a very good question. And I'm still hopeful in the decentralization aspect of it, even if there will be consolidation. And I mean, I'm not playing on for the Kiln flag right now, because of course having more part of the market is one of our objectives, but as well as keeping the network decentralized. I think the difference between Bitcoin, because if you look at Bitcoin today, mining is a clear consensus mechanism that push the small players out of the network, right? It's like if you don't have if you don't pay your kilowatt 3 to 4 cents, while having great ASIC infrastructure to run it, to validate the Bitcoin network, then you're just out. And today, frankly, Bitcoin might be validated by 40, 50 main companies, if not less. There's a lot. I can list you at least 3 companies that have more than 10% of the validation power on Bitcoin. I can list you only 1 company that has this on Ethereum. So I think proof of stake in that sense is a better consensus mechanism to keep the network decentralized, because even in 5 years or 10 years, it will be easier and easier for a solo staker to run a validator on his computer, right? Which is the main difference from proof of work to proof of stake. Though, will it happen? That's the question you ask in the first place. I think there will be definitely a combination of it. I think that there will definitely be consolidation, because these ETF, for example, they will start to use 1, 2, or 3 or 4 providers, and they will need performance, insurance. I mean, everything institutional grade that I mentioned to you earlier, which a solo staker cannot provide. But maybe there's a solo staker type of aggregator that helps them to decentralize also their staking sets, because they have the incentives to keep Ethereum decentralized. If you think about it as well, right? And I think a part of the validation power will be run by solo stakers and the ones that are decentralization maxi, and we need them, right? We need them to keep Ethereum decentralized. So by the way, one of the reasons we offer a liquid staking product and DeFi products to our customers, we can talk about it later, is because of course they ask it, but also because we don't want to be in a world where we have to keep growing on the staking business, and it actually could potentially hurt the decentralization of the network itself that we are trying to secure in the first place.
There's efforts underway kind of in the Ethereum ecosystem to kind of make staking easier in terms of capital requirements. So currently you need 32 ETH, which is $100,000. And kind of the idea is to kind of reduce this markedly. What are your thoughts on this?
I think it's great. I think it also advantage us in a way, because it concentrates the we won't have to run that many validators anymore. We will be able to merge validators one to another and run as much as 64 validators, 2048 ETH. I don't know. Please, I'm not sure about the calculation, but I think that's it. And these 64 validators, this 2048 ETH versus 32 will kind of auto compound, right? So you will have kind of like validator pools in a way at the protocol level, which is pretty compelling also for the large players, but it's also compelling for a solo staker because now the requirement will be much lower. So I think it's great. I think it's going the right way.
A little while ago, you kind of ventured outside of kind of your core staking business, and you kind of launched Kiln DeFi, which kind of lets your same clients kind of tap into DeFi yields. Tell us about that.
Yep. And actually, you remember we had a discussion. I think we were in Prague together at a conference, and that was the beginning of our discussion. We think it's evident that stablecoins will push the payment markets and the value market in general to an on-chain future. At least that's what we think, right? Like I like this quote from Safe: "Let's put the GDP on chain." Yes, let's put the GDP on chain. If we need to push the GDP on chain, stability in these transactions need to happen, and that's why stablecoins are there. And the stablecoin market already found product market fit. I think there's 170 billion stablecoins in circulation right now, USDT, USDC, and others. And we realized that most of our clients most of their clients had a lot of stablecoin on the platform, but wouldn't access rewards, wouldn't access yields. And there are some fantastic yields, on chain. The first ones are provided by lending and borrowing protocols, such as Morpho. I'm citing them first because I love them. It's not only because they're French, because I think it's a fantastic protocol, maybe one of the best, if not the best one out there. And there's Aave, and there's Compound, of course, and there's many others. And on the other side, it was only 4% at the time when we started. I think now it went up to 6-7% of stablecoins that were getting interest, right? Which, if you compare it to Ethereum is 30% of assets that are staked, and if you compare it to stakeable assets, so all POS assets, I think it's 45% of all POS assets that are staked. So this stablecoin rewards market is very immature, at least 10x. When we started, 10x less mature than the staking markets. So we thought, okay, well, as we did for staking, we'll provide the infrastructure for these exchanges, wallet custodians, banks, to offer stablecoin rewards. So that's how we started Kiln DeFi. We aggregated with our own smart contract vault infrastructure the main lending and borrowing platforms, so that these exchanges, wallets, custodians can start to monetize this while offering 10 or 15 different protocols on 10 or 15 different assets, stablecoin assets. And now we're expanding this to other type of rewards on chain. For example, if you want to lend ETH and get close to 8 or 10% type of rewards, and you're not happy of the 3% staking, you want higher type of yields, we also offer that. And maybe just lastly is like, retail customers, they need usually one-click experience. And if you want to keep them on-chain, which is all of our product do, is like keeping them on-chain, you need to simplify this experience on-chain. So if you want to, that's one of the reasons why a lot of customers were sitting on exchanges, not moving on-chain, because the UX is not as good as, I was like, the exchanges that can just build a front end and use omnibus setup in the background. Whereas now, you can start to build with passkey, kind of abstraction. The onboarding is getting much better, and also the on-chain experience. The one click, you can rebalance from any yield position to the other on-chain in one click, whatever the asset, whatever the DeFi protocol, whatever the chain is. And that's something we heavily working on, and that's something that will increase the adoption of these products on chain.
How do you evaluate which products to include in this? Because kind of like you're, in a way, this is a huge endorsement, right? Because kind of like if I'm your client, I kind of expect you to kind of do the due diligence on these protocols.
Yeah, that's a very good question, and you would be disappointed of the answer, because frankly, we started to take the ones that our clients wanted, and also the largest one, right? Like we assume that Aave and Morpho were great protocols when we started to offer them to our users. Then it starts to get tricky when, specifically in the case of Morpho, for example, when you have like different vaults, different risk profile that are managed by strategists and curators that are a third party that is managing the risk. So the risk is not even managed by the protocol itself; it's managed by a third party. So in that case, you also need to assess the risk of the third party. So what we're doing now, naturally, is like, as we did for smart contract. In the beginning, we had only security team outside of our company, right? We're using auditors like the Spearbit and the likes. And continuous monitoring tool where vendors like Exagate. But now we have a security team in house, and we still use these external providers, but we definitely need an expertise in house. It's going to be the same for risk in DeFi. We assess external vendors, and we are building a risk team in house. So to say, hey, why are we pushing this type of vault on Morpho managed by this curator with this risk rewards approach versus the other, because it's not the only curator that managed vaults on Morpho. So that's what we building at the moment, and I guess that's what our clients as well will require in the future.
Yeah, that makes a lot of sense. When you look at your clients, and I mean, you have your ear to the ground here, right? So kind of when it comes to institutional investors and so on, are they in it just for the yield, or do they also kind of believe in the underlying asset? Do you think kind of in as how much do you think this capital is mercenary?
It's hard to tell. It's hard to tell. They definitely have to run a business, right? And to see the revenue opportunity. So in that sense, but I don't think mercenary is the right word, because if it's a short term, like a platform that is thinking 10, 20, 30 years ahead and say, hey, actually the world is going to, or the transaction on this planet will be on chain. So I still want to be there in 20 years, cannot offer a yield that is short term, right? If they don't believe, for example, I'll give you an example. If they don't believe in Bitcoin staking, I can tell you, I'm not going to cite some platforms, but they won't offer it. Regardless of the revenue they can make, regardless of the amount of Bitcoin they have on the platform, which is much higher than any other assets, because they're thinking long term, right? They're thinking, well, I mean, I don't really understand the risk yet, so I don't want to offer it to my users, even if I know the day they will launch it, it will be a success, because suddenly people can start to have yields on Bitcoin. Same for stablecoins. So we tend to think that most of our largest clients, largest platform, they think long term. So they really still assess the risk. And I don't think mastery is the word here. They're thinking, okay, is this source of yields sustainable? Is basically for our clients, lending makes sense because there's borrowers on the other side of the spectrum, and it will essentially make this economy better. Okay, I'm able to support it. And same for us. Like we're thinking long term. We definitely need to grow our revenue and the yield we offer on the platform. But if we have one fuck up, let's say, like it's the end of our business. And if we treat our customers or their customers badly, it's the end, right? So that's a good point. I think I think because we're starting to, for example, on Avimorpho, we're starting to see fintechs actually integrating this infrastructure to do credit lines, right? And you working in a way on this infrastructure as well, where basically you have a wallet, you have a card, you might have ETH on the wallet, but you still want to pay on USDC or Tether or basically stablecoin so that you can pay real life. We're starting to see proper use cases of that in the background. You need to lend your ETH against USDC, USDT, and then you have a credit where you spend your money in real life. So I think, and by the way, I think moving forward, the biggest part of the adoption is going to come from these use cases, because we think all the fintechs, the neobanks, the Stripe and alike, and we're seeing that they do, of course, a big push on stablecoin, will offer these type of rails. And in that case, it's like a saving account, right? You will need your saving account close to your payment accounts. And that's what we're trying to provide. We call it the saving account for the world. I hope, I hope we'll make it happen. I think this future is exciting to us.
Yeah, super cool. So what's on the roadmap for Kiln in the coming year or so?
Yeah, definitely enhancing any type of rewards on the platform, on chain, enhancing on-chain movement, right? I think, like, for example, exchanges, the first stack of an exchange that will move on chain is the earn section, because they don't need low latency of trading, and the earn section can move on chain before the others. So we'll definitely push the exchanges to move on chain, at least the earn section at first, because that's our topic. And we will also look at institutional adoption worldwide. The US is now opening up post-election, with the administration changing, though we're still waiting for more clarity, but the hope and excitement is there. And we'll try to build this saving account for the world, while still our mission is to democratize value creation in digital assets. We think once you're on chain, of course we have a business, of course we'll make revenue, but at least everyone will see how much we're making our commissions, and if we're really driving value to our clients. So that's what we'll try to do.
Cool. Those are super nice parting words. Tell us, where can we send listeners to kind of find out more about Kiln?
Yes, please go on our website, kiln.fi, stake on our dApps directly on the website or via our partners marketplace, Safe or Ledger. We have a Twitter account, LinkedIn for the movers, and in conferences. If you go on conferences and you see a Kiln t-shirt, please come and say hi.
Cool. Thank you so much for coming on, Laszlo.
Thanks, Federico.